Good afternoon, ladies and gentlemen, and welcome to the INSTEM Results and Company Update presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company, and we will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you would give that to your kind attention, we'd be most grateful. And I'd now like to hand over to Phil Reason and Nigel Goldsmith from INSTEM. Good afternoon to you both.
Hi, Mark. Very much. And welcome, everybody. We are very much looking forward to sharing some exciting progress for INSTEM during and subsequent to the first half of the year. As Mark said, it'd be great to be able to answer your questions. I don't normally hover on the disclaimer, but it is a reminder to say for the attentive amongst you that have attended an INSTEM presentation before, the disclaimer has changed slightly, and that is to remove the restriction that prevents us sharing our materials in North America, because we have a very deliberate process at the moment and project to extend our reach beyond the UK and European investor community, also out to North America. Very quickly, introductions. Nigel, do you want to go first?
Sure, thanks, Phil. So I'm Nigel Goldsmith. I'm the group's Chief Financial Officer. I've been with INSTEM in my 10 years now, just coming up to 10 years. I joined the company about a year after it IPO'd. I missed the first acquisition that they made since IPO, but I've been involved in all the rest of them. I'm based in Stone in Staffordshire in the UK headquarters, but I work very closely with Phil. I'm a member of the INSTEM PLC board as well. Thank you.
Thanks, Nigel. And I've been with INSTEM for over 30 years with this bit of INSTEM. INSTEM was larger than this business when I joined it since around 1995. Around 60% of our target market and probably 70 or 80% of our potential acquisition targets are in North America. So I moved to North America in 2003. I'm about 40 miles west of Philadelphia to help grow our North American presence. So today we are going to have a quick group overview. I'm conscious that a good number of you have listened to INSTEM presentations before, but we do have new people as well. So for those people that have heard the story more than once before, my apologies. We will get to some more current information and certainly leave time for Q&A. We'll have a look at the half one performance, look a little bit at acquisitive growth for the 3 acquisitions we've completed this year, move on to look a little bit at the 4 areas of the business and how they've performed during the first half, look at strategy and outlook, and then wrap up with a summary before Q&A. So what is INSTEM? So we are a leading provider of IT solutions and services, mainly technology-enabled outsourced services to the life sciences market. It covers a broad swathe of life sciences, so pharma, medical devices, chemical, agrochemical, but a big focus and a large proportion of our revenue comes from the pharmaceutical market. The business is all about enabling our customers to bring their life-enhancing products to market faster, never been brought to sharper focus than over the last 18 months or so, as we've helped our clients accelerate their COVID vaccines and therapies to market. In terms of how we're organized, we have 4 market-facing business units: study management, regulatory solutions, in silico solutions, and clinical trial acceleration solutions. You can see 2 of those are ringed in blue. That's because we've done 2 acquisitions in the study management area this year, and 1 acquisition which actually created the clinical trial acceleration solution business earlier this year. So we'll talk more about both of those businesses in the context of M&A. Study management is all about managing the workflow of laboratory and clinic studies, prompting the activities minute by minute that the clinicians, the technicians, the scientists are undertaking on the studies, collecting the data, validating the data, analyzing the data. Regulatory solutions is all about getting data in the hands of the regulatory authorities. So a big part of that business actually picks up where the study management solutions leave off. It imports and transforms data from study management solutions, INSTEM study management solutions, and third-party ones, including our competitors, and transforms the data into a standard called SEND, the standard for the exchange of non-clinical data, which is mandated by the FDA for submissions. And the other part of this business is getting data into the hands of country-by-country regulatory authorities for already approved drugs, but as they go to launch those, I say drugs, it's actually all manner of regulated products, and getting the necessary data in the hands of the country authorities to allow marketing of that regulated product territory by territory. In silico solutions is all about leveraging large volumes of historic data, so accessing and aggregating that data, aligning that data, so that you can then mine that data, apply AI algorithms to derive insight. And the final area, clinical trial acceleration, has two key areas to it. One is the statistical analysis of data from clinical trials and the formatting of that data to get that data in the hands of the regulatory authorities in the mandated standards. And the other area is around the anonymization of data from participants in clinical trials, so that data can be shared for insight generation purposes. When a subject participates in a clinical trial, their data is confidential. You're not allowed to use it beyond the trial without totally disassociating that data from the individual. In terms of where those solutions fit in the drug development life cycle, so at the top of this slide, we have the typical timeline and life cycle for a new drug. It takes about 12 or 13 years from registering a patent to take the drug through the R&D process and launch it in year 12 or 13. You are then left with 7 years of the patent protected life for that drug to recover the very expensive cost of R&D and to recover your profit. And our solutions, if we can help increase the amount of patent protected life for that product by reducing the amount of time it takes to bring a new drug to market, that has huge commercial return. And you can see our study management solutions sit from the discovery to the end of early phase clinical trials. Regulatory solutions picks up where mandated submissions start for non-clinical data and go right through clinical trials and into post-marketing. Our clinical trial acceleration, where we're doing analysis of clinical trial data, obviously overlaps with clinical trials, both before product launch and those surveillance studies that happen after drugs are launched. And our in silico solutions leverage data from right across the continuum, from early discovery to drugs that are on the market. And we are collecting data and leveraging that data at various stages of the R&D process. Having been in business and operating in this space for several decades, we've amassed a blue chip client base from some of the largest companies, including all 25 of the top 25 pharma companies, similar proportions of the top contract research organizations who today undertake a large volume of the studies, both non-clinical studies and clinical trials that are undertaken for drug development, but as well as many academic institutions and smaller pharma and life sciences businesses. Despite having over 700 clients, the market is very large. There are over 4,000 pharma companies with drugs at some point of the regulatory R&D process, as well as many others that haven't yet got to the regulatory stage, together with the contract research organizations and academics. So well over 4,000 target companies. So still lots of new companies for us to go after. It's very much a global industry. So even though we're a modest sized business with about 480 people today, those people are all over the world. Our bigger clients, it's not unusual for them to have R&D facilities in North America, in Europe, in Asia, and they expect to get the same quality of service in their time zone, in their language, wherever it is they operate. Because of our presence, our success over the years, our penetration in the market, we've developed a fantastic reputation, and that reflects in very high levels of retention of our solutions in the clients. We report the retention rate based on the annual recurring revenue, so that could be annual fees or SaaS subscriptions, and how that compares from one year to the next for the same products, for the same clients. We have a target that is over 98% each year, and we've comfortably beat that every reporting period for the last 10 years. And we also have very strong win rates for new business. You will see from a later slide that we are a market leader in the vast majority of areas that we do business. We are very fortunate that for the last 7 or 8 years, the life sciences market has been growing strongly. The chart on the top right is the total number of drugs in the regulatory stages of the global R&D pipeline. You can see that that grew well again from 2020 to 21. When there are more drugs in the pipeline, there are more studies being run. The pharma companies and the CROs need more staff. When they need more staff, they need more users of the software, the INSTEM software that underpins those studies that they are undertaking. The CROs, when the market is busy, are also growing and generating profits. And if they don't already have the whole portfolio of INSTEM solutions, they are also at a healthy state financially to be able to invest in the things that will help improve their business going forward, as well as the pharma companies investing in those solutions. And the chart in the bottom right, for many years, INSTEM was focused in the preclinical or non-clinical stage of R&D. That was the area that actually grew fastest from 20 to 2021. You will probably be aware that a lot of late-stage clinical trials were delayed during the COVID pandemic, as the healthcare industry had to focus its attention on treating COVID patients and didn't have the bandwidth to be able to undertake clinical trials for new potential drugs. Those clinical trials, as patient populations with COVID have reduced, have started to resurface again, and that is growing strongly. But the preclinical area never missed a beat, as well as continuing to manage a large and growing pipeline of drug candidates. They just added additional work for COVID-19 vaccines and therapies, and that contributed to us and the industry at large being very busy. So this very positive market dynamic has obviously been great for our business, but also great for many other businesses in the life sciences. That said, there has been some small COVID impact on INSTEM. Generally speaking, things have been very robust for us. As a business, we're very fortunate that all of our staff very quickly transitioned to working at home. They've carried on working from home. Most of our offices are now able to open, but we have very few of our 480 staff going into offices every day. And actually looking forward, it's likely that forever we will have a much greater balance of home workers and hybrid workers than we had pre-COVID. Where we have had some delays, we'll talk about those coming into subsequent slides in particular areas of the business. But overall, our performance in our business has been extremely resilient. Just before we move on to financial performance, a few operational strategic highlights. As Nigel will tell you, our financial performance has been tremendous, helped by both overall growth in the market, but also an ongoing transition of our software deployment from clients deploying on-premises to moving to SaaS deployment through INSTEM data centers, which provides incremental revenue and increased visibility of earnings. We are not just market leaders, but thought leaders in many of the areas we do business. We work very closely with regulators, particularly the Food and Drug Administration, as they look at how they can help the industry advance new approaches to drug R&D that will radically reduce that 12 to 13 years to bring drugs to market, while still serving one of their primary purposes, which is to ensure that only safe products come to market. And they are very heavily involved, particularly in things like our in silico solutions, where they help us validate predictive algorithms that will ultimately replace laboratory and clinical studies. Equally, we collaborate heavily with our clients on new solutions in new areas that help implement new scientific approaches or new technology approaches to R&D. The great thing is, both organically and acquisitively, we've broadened our product portfolio once again, which provides greater diversification. If an area is in great demand in the market, that's good. That might from time to time compensate for areas where there is less demand. The demand for our products can fluctuate year to year, actually, as we'll see when we come to look at some of the revenue graphs. But having a bigger portfolio allows us to cross-sell to our very large existing client base, a broader portfolio. And obviously, we'll come on to talk about the 3 acquisitions that we've made. With that, I will turn over to Nigel.
Okay, thanks, Phil. Can you hear me okay?
All good, Nigel.
Thank you very much. Okay, so it's just a snapshot of the key numbers. Obviously, there's a lot of detail in the announcement that we made today, but these are the headline numbers in terms of revenues at 19.8 million. That obviously includes part contributions for the 6 months from the 2 acquisitions we made, the Edge and DWise, as well as the organic growth from INSTEM. And the organic growth, which is sometimes masked when you're sort of busy making acquisitions, was 8% on the absolute numbers, and on a constant currency basis was actually 16% due to the US dollar movement in the period. So we were very pleased with the overall result. I'll flag now, as you can see on the notes at the bottom there, those of you who have read the announcement this morning will see the references to a fair value adjustment that was made in the half year of £650,000. This arose from the fair value accounting when we acquired DWise. There's an exercise ongoing at the moment to identify the adjustments from that fair value, and the one item that's been identified, the only item that's been identified from the 2 acquisitions in the first half, was an adjustment to the deferred revenue that we've acquired from DWise. The provisional estimates are that the cost would be £1 million, which is a reduction in the deferred revenue that we acquired from them. and therefore £1 million less that we'll be reflecting in our consolidated numbers going forward. We've taken 650,000 as a charge in the first half, so that's incorporated into these numbers, and therefore there's another 350,000 provisionally expected in the second half of the year. The overall exercise is ongoing. It will be finalised in this half. It will be audited, and the full results will be reflected in our full 12-month results when we publish those at the end of the year. If anything, we hope that we can improve on that situation and actually pull back a little bit. But the analysts today have marked us down as a result of that. What I would also say, though, is that we've also been marked up as for the underlying performance of the business, and that's really what I wanted to say, that the fair value adjustment should not mask the fact that we've had an excellent trading performance and ongoing performance. The fair value adjustment is not, it's a non-cash item. It's ring fenced for 2021. There's no impact on 2022 or any other years, and we see it as a one-off accounting technical adjustment that should just be, it's there, it's reflected in the numbers, but it shouldn't impact on your views of the underlying business of the company. In terms of the other results shown on here, probably a couple of points to mention on EBITDA margins at 21%, which stays level with the prior year, which is actually, we were really pleased because the two acquisitions that we made in the first half, DWise actually has lower than average INSTEM margins. The Edge has slightly higher than average INSTEM margins, so it's a blended rate going forward. We stick with our pre-stated ambitions and expectations that our EBITDA margins can rise to 25% in the next 2 to 3 years as a target, and hopefully push on from there. We see the way that can be done, really leveraging our global infrastructure. We've spent a lot of money on building that over the last few years, and we see that as really the catalyst for us to drive now top line growth, which will then flow down to profitability. Already, DWise, for example, who have a large number of external contractors that they use, are all North America based. They have already been talking to us about utilising our offshore capabilities in India to provide some of those services, and clearly that will reduce their blended cost of providing services and products to our customers. So that's one area of where we can improve margins. Secondly, on the transition to SaaS, and Phil will refer to that a little bit later, but again, that continues at pace. 29% increase in our SaaS revenues on the year-for-year like basis. So again, very pleased with that continuing progress, and that will no doubt increase our margins as well. And the other point on this slide is cash. As you can see here, at the half year, we had just under 18 million of gross cash, and we utilised that to fund the whole of the PDS acquisition that we made in the early part of this second half. Those of you who have been tracking us will be aware that we raised 15 million as equity funds last year to fund the two acquisitions that we made in the first half. Those funds are either spent or committed, and therefore we utilised our ongoing cash resources to fund PDS. And we believe that our organic cash conversion, which is very strong, can continue to fund small to medium-sized bolt-on deals, combined with offering stock in INSTEM, which we've done historically on all our acquisitions. But if we do need anything in terms of a larger pool of funds to buy a more transformational deal like we did with DWise, then we'd be looking for alternative sources of funding. Okay. Lots of detail on this slide, which I won't go through on a line-by-line basis. I'll have a couple of slides on revenue. Phil will be referring to the revenue splits by business units a little later. As I mentioned, constant currency was, and it always is, an impact on us because of the fact that we transact up to 60% of our revenues in the US. So we're always mindful of that. However, we do have a cost base in the US, which is a natural hedge for us. So even if there's an impact on the top line, the profitability impact is usually minimal. And again, that was the case in this first half. The operating expense base is primarily people. As Phil mentioned, we have 480 people on the staff at the moment. By the end of the year, with filling vacancies, we anticipate it being around about 500,000, sorry, and 500 people, beg your pardon, and the majority of those form our cost base, 73%, as you can see there, of our total costs. We do flag the fact that we continue to spend money on our software development, and as in prior years, we've spent over £2 million, a little more than the half last year, because of the 2 acquisitions who've also been spending on development of their products, of which we capitalised just under 50% of that. If you strip out the acquisitions, our like-for-like operating costs just increased by an inflationary factor. The other point probably to mention just further down on this slide is on the pension scheme deficit. Not something we would normally flag because it is it's just a number on a declining number in terms of percentage of total liabilities on our balance sheet. But it was just to mention that we have had a triennial valuation carried out. That results of that came through in the second half. They will be reflected in our full year results. Pleased to say that the annual cash contribution, which was previously just over £500,000 per annum, will not be any more than 600,000 going forward. So it'd be between 500 and 600,000 per annum. So not a material increase year on year. So the 2 slides I'm going to show on revenues. The first one is geographic, as you can see, and again demonstrates the growth and really dominance of the US market, North American market, including Canada. That's been exacerbated in the first half by the acquisition of DWise, where the majority of their revenues are in North America. But nevertheless, that's been a consistent, really important market for us over the years. The rest of the revenues are split fairly evenly across the rest of the world, as you can see. I'm pleased to say that in all 3 areas, rest of Europe and UK, they've all increased over the prior year. So that's obviously a pleasing trend as well. And my final financial slide is just the revenues by type. So on the left-hand side, you can see it broken out there by the different types of revenue that we sell, products and services. On the right-hand bar, which is the most recent 6 months, the top of the bar is the SaaS revenue, which continues to grow, and that's been stripped out and shown on the right-hand side. As you can see, there's been a steady progression there as we convert our existing customers to a SaaS platform, as well as new customers. And in fact, in the first half of this year, the majority of the growth was on new customers moving straight onto a SaaS platform rather than conversion of existing customers. And for the first time this year, we have consulting revenues, which is the sky blue second bar on the or second segment on that bar on the right-hand side, which comes from the DWise acquisition. It's not an area of revenues that we've split out separately as consulting before, or any consulting has been included within our professional services. But obviously, it's a very strong and important line of revenues for DWise and now for the consolidated business. And so we will continue to show that as we go forward. And that's all from me. Thank you, Phil.
Thank you very much, Nigel. So just a couple of slides that talk to the acquisitions that we have completed in 2021. We have talked more about the Edge and DWise earlier this year on IMC presentations. So if you'd like a deeper dive, you will find recordings that cover these. But just as a quick reminder, the Edge, a UK business headquartered in the Guildford area, revenues of around £2 million. We acquired for up to £8.5 million on the 1st of March. Specialises in discovery study management. This is an area that is less mature, is less or has been less sticky with its solution providers, and where therefore there is a considerable organic growth opportunity. Much more so than the other areas of study management, which are more mature, There isn't a lot of churn between the suppliers, generate great recurring revenue, but lower top-line growth. Very excited by the potential here. It's an area that our clients were very keen that we brought something into the portfolio in discovery study management. Then on the 1st of April, we acquired DWise, a North Carolina, US headquartered business for up to 31 million. That completed on the 1st of April. I've lost the slides. Oh, they're back. As I said earlier on when we did the quick introductions to the business units, are in statistical computing and clinical trial transparency. It's a strong team, a bigger business, by far the biggest business that we have acquired. Revenue in 2020 of around $20 million or a little more, and settled well into the INSTEM business. Both of these businesses are integrating very well, still relatively early days. Both have 12-month earnouts, so integration was a relatively light touch and has completed for them both already in phase one. The more invasive acquisition integration will happen in the first half of next year when their earnouts complete, and we can do more disruptive things, and that's where some of the greatest synergy opportunities will exist as we come together more comprehensively during 2022, but both performing well. And then post-period end, we acquired on the 1st of September PDS, or Pathology Data Systems. This is a long-standing competitor for our Provantis product in non-clinical safety assessment in study management, where we are a market leader by some way. PDS have a directly competing product called a CentOS, number 3 in the market. But also PDS have a technology offering in the SEND space, where they are number 3 in that market. And INSTEM, again, is a clear market leader. We probably have about an 80% market share as INSTEM in SEND technology. And PDS is the number 2 provider in SEND outsourced services, where they leverage their technology platform, as INSTEM does, to offer services where clients send us the data in the form they've collected it. We put it through our technology platforms and send them back submission-ready data sets. So great opportunity to increase market share. It's an acquisition target that we've been trying to acquire for probably 10 or 12 years. We've made a start on acquisition processes 2 or 3 times over those years, of various reasons. Those opportunities haven't advanced, so it's great to complete it. The management team, who we've been working closely with, very excited about joining us, and obviously the wider staff, when we've announced it to them, understandably a little bit more concerned when being acquired by a major direct competitor, but we've been at pains to reassure them this is all about revenue growth, not cost savings, and that their talents are really important, and their deep domain expertise in this space will enable us to extend our technology suite and our outsourced services, and to meet the needs of clients, both with the solutions we've got and new solutions that we are excited to develop and introduce. It's been very well received in the market. Obviously, there could have been a concern in the industry that we were removing an element of choice in the market by acquiring a competitor, and ultimately we will rationalize the products so we no longer have multiple product offerings in this space. But the reality is INSTEM's reputation is very high. People recognize that we will not abuse an even greater market leadership position, and they recognize the upside of 2 strong businesses coming together. So just a little bit of an update on the performance across the 4 business units, initially financially. So this is revenue, H1 last year to H1 this year. You can see that there was huge growth in study management. About 800,000 of that is a consequence of the acquisition of The Edge, which contributed 4 months revenue in the first half, and 9 million of organic growth, up significantly from 7.1 million last year. Out of pattern with what we have advised to be the sort of medium-term trend here, which is to expect revenue growth of 5% or a little bit more year on year. And this is heavily benefited from a very large transaction with one of our largest clients, a big contract research organization who was growing very strongly and has licensed a large number of additional users to support that growth in staff, as well as collaborating heavily with us to develop our products in certain areas that will help with their operational effectiveness and efficiency. So great performance in study management, but a little bit anomalous. We're not expecting that level of growth period on period. In Silico Solutions, you can see went backwards a little bit, H1 of last year to H1 of this year. Again, slightly at odds with the guidance we've provided here for medium-term growth, which is expected to be in the high single digits or low double digits year on year. This area has 2 areas of focus. Software offerings that came with an acquisition in November of 2019 under the brand LeadScope, and then an technology-enabled outsourced service leveraging a tech platform called Knowledge Scan and a particular application of that platform for target safety assessment. LeadScope continued to perform extremely well, as it has ever since the acquisition. It was ahead of expectation. Target safety assessment services, outsourced services, were quieter in H2 of 2020 and again in H1 of 2021, largely COVID impacted, where pharma scientists, who are the customers for our target safety assessment business, where we are replacing largely manual activities with a big data and AI technology solution, which is a disruptive approach to this type of science. The scientists for the pharma companies were allowed to continue to work at home. That meant they were doing less laboratory science and could spend more time on the data-intensive activities, which meant they did more of that target safety assessment work in-house. As they have returned to their laboratories, business has picked up for us in Q3 of this year, and we expect a strong second half to 2021. Regulatory solutions, again, it's an area you can see that was down year on year. This is really due to a difficult comparator with H1 of 2020. For those people who have been on calls with us, they will know that after about 18 months to 2 years of having a very successful outsourced send services arrangement with one of the top 5 CROs in the world, they got acquired by the second biggest CRO in the world, Covance, actually owned by an even bigger US business called LabCorp. Covance have a philosophy of doing this work in-house. They told the acquired business they would have to bring this work in-house. They gave us 6 months notice, and that work terminated on the 30th of June last year. And that meant that £600,000 worth of revenue that we had from that contract in H1 of 2020, there was no revenue from that client in H1 of 2021. So that difference you see there of 600,000 is entirely accounted for by the loss of that one customer. And you see the maiden performance of 3 months of the DWise acquisition in H1 of this year. I'm not going to talk at length to each of the single slides on each of the 4 business units. Study management, we've already seen, had great revenue growth. This is an area where we have the greatest opportunity to transition long-standing clients from deploying our software on-premise to moving it to SaaS deployment and giving us some incremental revenue. That made some reasonable progress in the first half of this year, although most of the SaaS growth was brand new clients adopting SaaS from the outset, meaning that we still have lots of incremental revenue to achieve as more and more clients make that transition from on-premise to SaaS. And once again, the Chinese market has been really robust. INSTEM is a market leader by a long way in the Chinese market. And as new contract research organizations come into the industry, they routinely adopt INSTEM's technology. Regulatory solutions, we have talked quite a lot about this. Not a huge amount more to say. Generally, a very strong and positive area for us, with that exception of that one client loss from last year. In silico solutions, we've talked about at length. Expect some additional news from us related to the launch of some new predictive analytics software solutions. We've been collaborating heavily with the FDA and an industry consortium, and during the balance of this year, we may expect to launch a number of new chargeable solutions, which we'll talk more about when we talk about the full year results next March. And we will obviously hope to report on that improving target safety assessment growth at the same time. And clinical trial acceleration. Strong progress I would pick out on a new product development, although, as Nigel mentioned, this is a business with a substantial consultancy offering, which is very attractive to us and one of the reasons we acquired this business. It's also a business that is looking to increase its software product portfolio. And one of the things that they saw as being very attractive about joining INSTEM was the strength that we could bring to them as a leading provider of software solutions into pharma R&D. And they have been working hard on a new enterprise statistical computing environment solution called Aspire, where they've launched a number of the initial modules of Aspire during the first half of this year, and work goes on collaboratively with clients to build out that Aspire platform. Just a little bit of data that we shared for the first time earlier this year on an IMC presentation that gives a sense as to the total available market in the 4 areas in which INSTEM operates. You can see there that if you quickly added that up, there's about £1.5 billion worth of market spend expected in over the next 5 years in those areas. So still lots of market opportunity for us to go after. You can see our expected growth rates that I talked a little bit about earlier on, and you can see our market position based on revenue, client penetration, the rate of new business wins, where in the vast majority of areas based on what we're selling and our market share, we are a market leader or close behind market leaders. And there is a question in the questions area already around competitors, and you can see some names of competitors, and we'll pick up on the balance of that question when we get to Q&A. So strategy and outlook. 3 threads to our strategy going forward. Organic revenue growth. Clearly, we've demonstrated there is great potential for organic revenue growth during the first half, with 16% on a constant currency basis. There's lots of opportunities, a lot of them driven by cross-selling to enlarge client base of an enlarged product and service portfolio that we introduce organically and acquisitively. margin improvement that Nigel has talked about at length, and I won't talk more to, and then accretive M&A. This is an industry that remains very fragmented, the life sciences IT supplier community, and the clients are desperate to see consolidation of the hundreds and hundreds of companies that provide IT solutions. In terms of M&A, again, as Nigel talked about, we've deployed the 15 million that we raised last year. We continue to generate cash organically that will allow us to do smaller acquisitions. Our focus is, at the moment, the successful integration of the acquisitions that we've done, and we don't expect to be announcing the consummation of any further acquisitions over the next 6 to 9 months. But we are actively mapping out the enlarged acquisition landscape as a consequence of acquiring the Edge earlier this year, and therefore a greater presence in discovery, which gives us a greater rationale for acquisitions in and around the discovery space, but also the acquisition of DWise in late stage clinical, and again, a whole set of acquisition targets in and around the DWise business. So we are mapping out that wider landscape with our investment banking partner. We will prioritize the areas that we want to focus on during next year, start the reach out to acquisition targets. So reasonable to expect that that whole process could turn into acquisitions in the second half of 2022. So in summary, a material increase in our financial performance and market reach, operating in a very robust life sciences market that is growing and investing, with our recurring revenue and repeat services business, a very resilient business model, which we've proven during COVID-19, a very large client base that wants to buy more from us and is helping us introduce new products organically, and is recommending acquisition targets for us. The ability, therefore, to cross-sell to existing clients as well as attracting new clients to get incremental revenue and margin improvement with the move to SaaS, and a business that we believe is very well positioned. So that's as much as we're going to cover in the presentation. I see that we've got a couple of questions already in the Q&A, which we will turn to, but I would encourage you to continue to ask questions. Mark, anything you'd like to say before we jump into the Q&A?
That's great. Thank you very much. Thank you very much indeed, Phil. Ladies and gentlemen, as Phil's just mentioned, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and once this meeting's concluded, we will redirect you in order that you can provide your views and expectations directly to the company. Phil, as you said, you've had a number of questions submitted. Perhaps I could just hand back to you, if I may, and Nigel, and if I could ask you just to read out the questions and give a response where it's appropriate to do so, and I will pick up from you at the end.
Sure. Thank you very much, Mark. So Andy had that first question around who are your competitors. So I have flicked back to this slide where in the final column, you can see that the competitors, we have some competitors. I suppose you've got an example here, Zybian, who have been a long-term number 2 in the study management software market. They also reappear in the Send technology space, and actually more recently there were late entrants to the outsourced services market. They don't do an awful lot of business in that space, but they're trying in more ways than one. Whereas in other areas you'll see competitors that are just isolated to one particular domain. In the main, businesses are smaller than INSTEM, quite often a lot smaller, although there are some areas where we compete with businesses of INSTEM size, or maybe big businesses with a division where we compete. So Danaher, a large multi-billion-dollar company, They acquired a UK business called IDBS a number of years ago, who was one of the main competitors in discovery study management for the Edge. Dotmatics, another UK business, little bit smaller than INSTEM. They were acquired last year by Insightful Science. And then you have some big businesses like IQVIA, a very large clinical CRO, but they also have a very large IT division. So we compete against both very large businesses and much more modest-sized businesses. And he also said, do you see further consolidation in the sector? The answer is very much yes. We are very much an acquirer, and there are sort of 3 or 4, I would say, other very active acquirers. Until recently, we were acquiring in slightly different areas of the life sciences space. So we typically weren't competing for acquisition targets. But as our business has broadened and moved into new areas, and their businesses have moved into new areas, we do increasingly bump up against other acquirers that we're competing for the most attractive businesses. But there are a lot of targets, and a lot of our work is associated with reaching out to businesses that aren't for sale, explaining why INSTEM would be a fantastic acquirer, and ideally encouraging that business to become part of the INSTEM family without considering other potential acquirers. And Andy's sort of last question, at what point does INSTEM turn into a target? Well, it will probably come as no surprise to you that we are the target of continual inbound interest from potential strategic acquirers, continual interest from private equity acquirers. But as of right now, we believe that we can continue to deliver fantastic value to our stakeholders as a standalone business on AIM. We've seen great share price appreciation, obviously. We've seen great growth in our staff numbers and opportunity for our staff, and we've seen great growth in our product portfolio for our customers. So right now, we don't see any compelling reason to advance those incoming interests, but obviously we also have a duty as a public company to take those inbound inquiries seriously, and if anything truly compelling comes in, then obviously we have an obligation to reach out to shareholders. So Andy, thank you very much for your question. Let's move to Simon. Have you retained the key staff from your recent acquisitions? The answer to that is yes. We do a tremendous job of selling why INSTEM is a great home for acquired businesses, and then doing a great job of delivering on the expectations we've set. We are in a very fortunate position that as a serial acquirer, we can put acquisition target staff in contact with many reference individuals that have joined INSTEM with prior acquisitions and are still part of INSTEM, and have been very happy with what that has done for their career. If they've been shareholders in previous businesses and maybe they've taken INSTEM stock as part of a transaction, they can talk very positively about how rewarding that's been as they've been part of INSTEM's growth and success and share price escalation. So yes, we've kept recent staff in the same way that we've kept staff historically. So Brian, is there a variation in Ebitda margins across the 4 operating areas? One for you, Nigel.
Yeah, thanks, Phil. I think that the simple answer is not a large variation. We introduced segmental reporting into our accounting notes probably at the end of 2019 for the very first time, and we've been reporting on that since then. You'll see there the different operating segments, and we do have that in the RNS announcement today. And you'll see there that the the study management and regulatory solutions come up with contributions to central overheads, which are much higher percentages than the in silico solutions. Obviously, the clinical trial acceleration is a new one this time. And the reason for that is that a lot of the costs that are associated with the first two, study management and regulatory solutions, are actually centrally held and centrally controlled. We have a global operations team, and all of their costs would be allocated as indirect costs to those business units, whereas the in silico solutions are typically fairly self-contained in terms of their cost base. And so the actual comparatives of contributions to central overheads between the different business units is actually quite difficult. You can probably track it on a period by period within the same business unit, but when you actually get the true allocation across from the central overheads, you find that the Ebitda margins are generally fairly similar across all four segments.
Great, thanks, Nigel. John has asked, DWise has its own products. Are these being integrated, or are they to stand alone? So the DWise products, there is no comparative alternative within the INSTEM for competing alternative with the INSTEM portfolio, so they're additive. But it's a really good question related to integration. The reason our clients are so enthusiastic about seeing consolidation across this very fragmented IT landscape is that they want to integrate some of the workflow associated with the work that's being supported by these different IT solutions, so they don't end up re-entering data from system to system to system, which is very inefficient. But even more importantly, aggregating data across these solutions. And probably a really good example of this is a long-standing top 10 pharma company, Sanofi. One of their senior executives, the global head of safety assessment, is on our strategic advisory board. When we were just about to announce the DWise acquisition, it's normal for us to bring the strategic advisory board inside a few days early, so they can help us with the messaging as we announce these transactions to the market. This individual, Philippe Detelier, said, "This is really exciting. We have a very important project running in Sanofi to integrate data coming out of our non-clinical area with our clinical area. This is very difficult to do. INSTEM now, as a major player in the non-clinical data environment and the clinical data environment, is maybe an ideal partner for us to work with to help us with this endeavor." But what's really telling there is that we've been a long-standing partner of Sanofi. Philippe is a very good friend and a very strong advisor and advocate for us within Sanofi. And yet, until we acquired DWise and got that expertise in the clinical space, Philippe did not reach out to us and say, "How can you help us with this difficult project?" And what it identifies is the opportunity that we create as we bring in that expertise across these domains. So really good question. Thanks, John. Simon has asked another question. What business segment excites you the most? It's probably always wrong for the CEO to show favoritism, but I've got to say that the in silico area is exciting for us all, because this is the area that probably shows the greatest potential to radically reduce the amount of time it takes to bring new drugs to market. Laboratory experiments, clinical studies, you can improve their efficiency, but it's very difficult to make them go a lot faster than they are required to go by regulation. Whereas in silico approaches, you might replace a 2-year non-clinical study that has to run for 2 years with something that you could run in 2 weeks. And so the potential here to accelerate bringing major new therapies to market and meeting unmet medical need. Really exciting in the in silico space. Great opportunity for patient populations around the world, for clients, and for our other stakeholders and investors. I'm conscious that we're a couple of minutes over, Mark. I guess we ought to wrap up there, so I'll hand back to you.
That's brilliant. Thank you very much, Phil, and to you, Nigel, as well, for updating investors once again. I know that investor feedback is important. I'll shortly redirect investors to give you their thoughts and expectations, but perhaps before doing so, Phil, I could just ask you for a few closing comments to wrap up with.
Yes, so firstly, thank you very much to you all. It's clearly a really exciting time for us as a business. To those of you who are shareholders, thank you. I'm really pleased that you've participated in great success and have been helping with your investment in INSTEM. Organic growth has never been stronger. We're operating in a life sciences market that has never been more buoyant, and we have great opportunities ahead of us. So thank you very much, and we look forward to speaking to you again in the coming months.
That's great. To Phil and to Nigel, thank you so much for updating investors this afternoon. Ladies and gentlemen, please don't close this session, as we'll now automatically redirect you for the opportunity to provide the company with your feedback. This will enable them to clearly understand your views and expectations. It will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of INSTEM PLC, we'd like to thank you very much indeed for attending today's presentation. That now concludes the session, and good afternoon to you all. Thank you once again.